Get ready to take a trip down memory lane as we delve into one of the most tumultuous times in recent history, the Great Recession of 2008. This economic collapse shook the world to its core, with waves that reverberated across every continent and country, leaving no one untouched. As the dust settled, fingers were pointed and blame was cast, with everyone searching for answers as to who caused this catastrophe and who should be held accountable. In this captivating video, we'll uncover how insurance giant AIG managed to avoid taking responsibility for its role in the financial collapse, even though it was the single biggest contributor to the Great Recession. But before we get into the details of AIG's involvement, we need to rewind and understand the events leading up to the crash. At the end of the 1990s, the US was experiencing a surge of foreign investment from countries like Russia and various Asian nations that were grappling with their own financial crises. So sit back, relax, and let's take a journey through time to explore the events that led to the Great Recession and how AIG managed to escape unscathed despite being a significant player in the disaster. Let's dive into the murky waters of the American banking system, where easy money and the American dream collided with disastrous consequences. Banks were flush with cash, but they didn't want it just lying around, so they made it simple to obtain mortgages as a way to lend that cash. Suddenly, even those who wouldn't normally qualify for a loan found themselves approved for mortgages and able to buy their dream homes. But these weren't your typical mortgages. They were subprime mortgages, risky loans with lower credit scores and adjustable rates. As banks continued to make it easier to get loans, they bundled thousands of these subprime mortgages together into a single bond, known as a CDO, then sold them to other parties like insurance companies, pension funds, and other banks. The problem was that these subprime mortgages were riskier, and many of the usual buyers of CDOs couldn't afford to take the risk unless the banks were up to something fishy. Enter AIG, the insurance giant that played a significant role in the 2008 financial crisis. If you bought an insurance policy protecting you from a CDO failure, then you could buy it much more freely. And that's where AIG comes in. It sold insurance on these risky CDOs, effectively taking on the risk that others couldn't. This allowed banks to keep selling subprime mortgages and keep the cash flowing, even though the risks were mounting. AIG was a titan in the insurance world, with subsidiaries and offices spanning more than 80 countries. With a history dating back to 1919, AIG had earned a reputation as America's largest insurance underwriter. By 2008, the company had amassed hundreds of billions of dollars in assets and was well on its way to becoming the first trillion-dollar company in the world. But what really put AIG on the map was its financial wizardry. In a small London office, AIG worked its magic, turning risky CDOs into safer investments. They did this by selling insurance policies to CDOs with terrible credit ratings, effectively swapping out the bad rating for their own strong rating. This policy, known as a credit default swap, made it seem like there was little to no risk involved in buying these CDO bonds from the banks. Why would AIG take on this risk? Simple. They loved credit default swaps, and so did the fund companies. With AIG willing to pay out if the bonds failed, investors felt secure in buying them, and the banks could keep selling subprime mortgages. It seemed like a win-win situation until it all came crashing down. It was the year 2008 when the world was hit by one of the biggest economic crises in history, with the entire global economy teetering on the brink of collapse. But what was the cause of this catastrophic breakdown? Well, it all started with the American dream of owning a home, and banks made it incredibly easy to obtain mortgages by creating adjustable rate mortgages and accepting people with lower credit scores. These subprime mortgages were then bundled together into bonds called CDOs and sold to other parties. However, since subprime mortgages were risky, funds that would normally buy these bonds couldn't afford to take the risk unless the banks were operating a bit of a financial scam. That's where AIG comes in. AIG, the largest insurance company in America, sold insurance policies to CDOs to protect against failure. This policy was known as a credit default swap and literally swapped the bad credit rating of a CDO with a great credit rating of a large insurance company. The Financial Products Division, a small office in London, made billions of dollars in revenue every year by selling these default swaps. AIG's strategy worked until the housing market crashed in 2007, and AIG realized it had secured too many CDOs to possibly pay up. Once AIG's coffers ran dry, all the banks that had insured them started to plummet. The collapse was staggering, with AIG running out of money on September 15, 2008, and later that same day, one of America's oldest and largest banks, Lehman Brothers, was forced into bankruptcy. The financial crisis of 2008 was a tumultuous time in America's history, and the story of AIG, the largest insurance company in the country at the time, is an important part of that narrative. AIG's assets were in the hundreds of billions of dollars, and they were well on their way to achieving $1 trillion market cap. In London, AIG's financial products division was making a killing, quadrupling its revenue to over $3 billion annually in just 5 years. They sold default swap credits and collected insurance premiums, making easy money. But greed got the best of AIG, and instead of obtaining capital to back up their insurance policies, they relied on the statistical probability that the housing market would fall. And fall it did. When the housing market crashed in 2007, AIG was left with too many CDOs to pay up. The banks that had insured them were counting on AIG to honor their end of the deal, but AIG realized it had secured too many CDOs to possibly pay up. AIG's coffers ran dry, and all the banks that had insured them started to plummet. AIG ran out of money on September 15, 2008, and later that same day, Lehman Brothers was forced into bankruptcy. The collapse was staggering, and the government realized that AIG was too big to fail. On September 16, 2008, just one day after the U.S. Treasury said there would be no more government bailouts, the government bailed out AIG. In exchange for a huge cash loan to pay these credit default swaps, the Federal Reserve took 80% of the shares in AIG and installed a new CEO, who was hired with a salary of just $1. AIG used $165 million of the bailout money to pay executive bonuses, but they were not for good performance. Instead, they were incentives to help undo years of bad financial practices. In total, AIG received a $182 billion bailout and reported the largest single loss in corporate history. As a result, they cut their staff to less than half of its 2008 numbers just to stay profitable. The story of AIG's downfall serves as a cautionary tale about the dangers of greed and the importance of responsible financial practices. It was a wake-up call for the government and the financial industry, and its impact was felt around the world. After the tumultuous events of the financial crisis and the government bailout, AIG eventually found itself on solid footing again. In fact, the government's investment in AIG ended up being quite profitable. After holding on to its stake for several years, the Federal Reserve sold its shares in 2012 for a stunning $22 billion profit. That's quite an achievement, considering the enormous scale of the bailout. It wasn't until 5 years later that the government decided AIG was no longer too big to fail and could be removed from the list. Since then, AIG has returned to its roots as a reliable provider of insurance services. Unlike some other financial institutions, AIG has never faced backlash for its role in the crisis. Perhaps that's because it relied on insurance fraud rather than other, riskier tactics. Whatever the case may be, AIG has emerged from the crisis with its reputation intact and its business thriving once again. As we've seen, this was a time of great upheaval, and the repercussions of the economic collapse continue to be felt to this day. It's important to learn from the mistakes of the past so that we can avoid repeating them in the future. Join us again for more insightful explorations of history and current events. I hope you enjoyed the video. If you did, please leave a comment with your thoughts and don't forget to hit the like button. If you're new here, make sure to subscribe for more videos like this in the future. Until next time, take care and have a great day.